The SEC, Securities and Exchange Commission in Nigeria, has put out a circular, a warning to public companies saying it's noticed repeated transmutation of independent non-executive directors to executive directors. Let's talk to Arise business analyst Chika Mbonu, who is joining us in Lagos to break this down. Good morning to you, Chika. Thank you so much for being with us. We've switched places. Good to see you.
Lotus, I hope you greet Uncle Bola for us when you're there.
I will, sir. What do you make of this SEC situation?
Okay, I mean, Lotus, for the pensioner in Zamfara State who is buying stocks from Nigerian exchange, or the salary earner in Imo State who's buying another stock or shares, they don't know any of these companies. They rely on what we call the corporate governance of the companies to make sure that the companies are being run properly in the interest of the shareholders of the company. And that's what SEC is continuously trying to guard, protect, to ensure companies are managed corporately. The corporate governance is at the optimum. So these initiatives you have seen, the first one being the fact that independent non-executive directors are transmuting to executive roles. That defeats the aim and the purpose of the independent non-executive directors, basically, which, as the name suggests, is to be independent and provide opinions dispassionate from those of the board or the management, because the MD of the company can be close to the chairman, even family, and so on and so forth. But there must be somebody there who is representing the shareholders and very independent. So the independent non-executive directors are being converted to MDs and EDs, and SEC says that should end because it defeats the aim of that. The other thing they thought about also is to remove staleness and the old boy network from running the public companies and other companies with significant public interests. They have put tenure limitations or tenure limits to the tenure of MDs and the executive directors. Initially at 10 years for the same company and 12 years for a group. And even when the MDs leave, they must have a cooling period of 3 years before they can come back as chairman. Again, all this is to enhance the corporate governance of the companies. Now, I must put it out there quickly for you that all the companies involved, they have written to SEC to provide more clarity to some of these initiatives. And I believe SEC will come out in a few days with the expansion or explanation to provide clarity where there are gray areas. But in sum total, this is to elevate corporate governance in the Nigerian public space among the quoted companies, to engender more confidence, investor confidence worldwide, and elevate things to the world standard. That's basically what this circular drives at.
Thank you so much for that, Chika. I also want to get to another matter, which is a warning from Fitch Ratings. You've talked about this a lot, but this time they're saying they have some concerns on the amount of debts. They're saying that banks are holding, government debts that Nigerian banks are holding. They said CRR is too high, and also mentioning that the 50% loan to deposit ratio has a non-performing loan risk. Also the restriction of net long FX positions. I mean, Chika, this is your area here amongst others. What do you make of this warning from Fitch to the banks?
Okay. Let me just pick them. You see, Treasury bill rates, the bond rates. I mean, okay, banks are supposed to take money from those who have surplus and give to those who have deficit. Basically, we expect that those who have deficit to be like the real sector, really, where the banks give out loans. Now, so the deposits come in, and then the banks have to, sweat this money to make money for their owners. But what happens now is you find that in the government space, also government is looking to borrow. And a lot of the government rates now is through treasury bills or bonds at about 22%. So banks a lot of risk managers are saying, why go lend to a sector, real sector that they're going to lose money when the government has a hungry appetite for loans. So why not put it there? So because of this, checks for government lending, the bonds, treasury bills, and so on, that 5% of the total assets of the banking system is in this kind of loans, treasury bills and bonds, basically, which is like sovereign assets. Now, they have done the work. Usually, we are taught that the sovereign assets are usually the best risk, treasury bills. But we saw what happened in Ghana, that treasury bill will relent in Ghana. Ghana taught us risk management because treasury bills, even had a head cut. So the FIS is saying that with this concentration risk of 35% of the total assets of banks, and the 350% of the capital in sovereign assets, if there is a problem in the economy, it might affect the solidity of banks. That's that one. That's the first thing. Second thing they thought about is the CRR. We have championed that in this program. That for Nigeria now, for example, CRR basically, if you bring in deposits into the Nigerian system, 100 naira into the Nigerian system, CBN sterilizes 50 naira out of it. And the banks can only play around with 50 naira. Even after the 50 naira, you have to meet your liquidity ratio of 30% again. So now, in the banking system, about 46% of the deposits of the banking system is sterilized in CBN and CRR, and it's non-earning. So whereas banks are paying interest on 100% deposit they get, less than 50% of it is what they're using to earn money for their owners. And that's what this is saying also. And so it's affecting the profitability of banks and the liquidity of banks. The life of the bank is in liquidity. Any bank that is not liquid has a problem. So you find banks that have 46% of their money in central bank going around looking for expensive funds. Meanwhile, they have this money in central bank. That's the problem. Added to that, there is a proviso that banks must maintain a loan to deposit ratio of 50%. So where would they get that? How would they comply in that? So to comply with that again, banks now have to go, because of the penalty involved, go and start booking loans that are lower risk. And then you know what the implication of that is, Rotus. Lower risk, high MPL. And that is what Fish is trying to address. Of course, along with the FX open position policy again.
Fantastic stuff. Arise business analyst Chika Mbonu. We ran out of time. Maybe tomorrow we'll talk about the new export trading company that's been set up in Nigeria. We thank you so much for your time, Chika. We appreciate your insights as always.